Good morning, everyone. I'm Vanda Vicars from the Global Risk Institute. I'm the Chief Operating Officer, and I'm pleased to welcome you to today's discussion on reforming Canada's deposit insurance system. Although this event is virtual and many of you are joining us from across Canada, I wanted to take a moment to acknowledge that the Global Risk Institute is situated on the traditional territory of many nations, is covered by Treaty 13 with the Mississaugas of the Credit, and is now home to many diverse First Nations, Inuit, and Métis people. Through this land acknowledgement, we want to bring context to the history of our country and the importance of working towards reconciliation in all the ways we can. Before we begin today, I'd like to remind you of a few housekeeping details. Please note that this session is being recorded and will be shared on our website at a future date. Your microphones have been muted to avoid background noise, and we've allocated ample time for questions during the Q&A period at the end of the event. Please submit your questions throughout the event through the chat bubble, which is on the bottom right-hand side of the screen, and please direct it to all panelists, and we'll address as many as time allows. Please be advised that CDIC representatives cannot comment directly on the Global Risk Institute's report or any policy implications regarding the deposit insurance framework. Any changes to the deposit insurance framework are the purview of Parliament and the Minister of Finance. CDIC's role is to administer the framework and set out in the CDIC Act and bylaws. We'd be grateful if you could keep this in mind during the question period today. And finally, when you exit this webinar, you'll see a prompt for our event survey. Please take a few moments to fill it out. Your feedback is very important to us and helps us continue to improve our programming. And now it's my pleasure to introduce our moderator for today's session, Gerard McDonald. He's the Managing Director and Head of Research here at GRI. Gerard, take it away.
Thank you very much, Vanda, and welcome to all of you who've taken the time to join us today. And on the attendee list, I even see a few names that I recognize from my past life in industry, so a special welcome to all of you. So today, Rita Achrekar and one of our executives in residence here at GRI and I are going to walk you through what we hope is an interesting and timely discussion on the future of deposit insurance in Canada. And we'll also hear from Michael Mercer from the CDIC as well after Rita and I have finished our presentation. And a reminder, exactly as Vanda said, please, throughout the course of the session, feel free to type your questions into the chat, and we'll get to as many as we can at the end of the session. So GRI released a report earlier this year entitled Deposit Insurance in Canada, Recommendations for Reform. It's available on our website, globalriskinstitute.org. If you haven't downloaded it yet, please do that. It reviews the current deposit insurance framework and recommends reforms to ensure it will continue to be an effective backstop for Canada's financial system and continue its role in maintaining financial stability. GRI thought this was an interesting topic for discussion because of the changes that have occurred in recent years, and you're going to hear more about in this session. Whether that's in the operating environment or the fact that the current federal limit of $100,000 in deposit insurance per person, per firm, per account hasn't changed since 2005, though the accounts that are covered have changed over that time. Now, in March of last year, many of you will be familiar with the regional bank crisis in the US. The rapid collapse of Silicon Valley Bank and Signature Bank signaled we were in a brand new era of risk when it came to bank runs. Technological and social factors have changed the operating environment for banks in Canada and elsewhere, and Rita will talk in a bit more detail about that. We live in a world where information and misinformation spread rapidly via social media, and the adoption of digital technologies by banks enables depositors to move funds with the swipe of a finger. And on top of that, and I'll talk a bit more in detail about this, we have the impact on banking stability of climate change, demographic shifts, advances in AI and other technologies. And all of this suggested it was a good time to review and update some of the elements of our federal deposit insurance system. And this is something that CDIC itself recognized with the launch of its deposit insurance study in February of 2023. And to look at potentially adding some additional flexibility to the system. Now, I think that many of you will be very familiar with the role of deposit insurance in preventing bank runs, maintaining financial stability, promotion of trust in the banking system, facilitating the effective resolution of troubled banks and interbank market stability. So we won't spend a lot of time of that, and we'll jump right into GRI's research. With that, I'll hand it over to Rita, an experienced corporate director and former banking executive with Scotia, Amex Bank, and ING, who has extensive experience in global capital markets, risk management, governance, and business transformation, to talk about some of the significant changes in the operating environment. And I think we can go right to page 3.
Thank you, Gerard, for that introduction. Good morning, everyone. It's a pleasure being here, and I want to thank you for joining us today to discuss this important topic. Let's take our minds back to March 9, 2023. It's reported that a prominent venture capital firm sent an email to its 200 portfolio companies suggesting that they withdraw their funds from Silicon Valley Bank. Within minutes, companies started transferring out their funds. This news spread rapidly through the VC community and the startup community, and they use private groups such as WhatsApp and Slack, as well as public platforms such as Twitter. By the end of the day on March 9th, nearly $42 billion, or 25% of total deposits, had left the bank. The next day, the bank was taken over by FDIC. The digital run was quite a bit different from the scenes we have seen in old black and white movies, people running to banks and teller windows to get their money out. Today, it's much easier to share information at scale through digital media, and also to transfer millions of dollars at the swipe of a button. After Silicon Valley Bank collapsed, a team of American economists crunched millions of tweets and concluded that social media exposure led to bank run risk rather than simply reflecting it. While social media and mobile banking are on 24/7, the Fed window operates during traditional banking hours. The time available to regulators and bankers to respond in a crisis or near failure situation has fallen dramatically since the global financial crisis of 2008. Looking ahead, AI-generated posts have the potential to spread misinformation, and we are already seeing their impact in the political arena. Another point I'd like to share is around nominal value. Since 2005, the CDIC cap has been held at 100,000, although this was reviewed in 2014 and maintained at the same level. Given changes in inflation, house prices, as well as stock index, it would suggest that a much higher amount would be appropriate. Next slide, please. And over to you, Gerard.
Thank you, Rita. And I must say, I liked your phrasing about the black and white movies and and people gathering at the tellers. It reminds me of one of my favorite movies, It's a Wonderful Life, where that was very evocatively shown. And I love watching that every Christmas. But back to business, and specifically business accounts. So we're on page 4. So one of the things that it's worth talking a bit about is the potential cascading impacts that business accounts with large uninsured balances can have. So currently, business accounts are treated the same as personal accounts, even though there are, generally speaking, higher governance standards for most businesses, and the fact that companies must maintain payroll at all times. And if businesses can't access their funds, this could mean issues in meeting payroll and potentially even layoffs. And this is where the cascading impacts come in. There could be downstream impacts on smaller businesses, vendors, employees, and this could contribute to broader issues in the economy, which could further exacerbate any potential financial stability issues that might exist or might have been causing the initial bank run. And as we will see when we talk about international deposit insurance coverage, some countries have recognized this and do have higher business account coverage. And another issue that is worth talking about in this context is the transmission of non-financial shocks. So as you see on the page here, we live in an increasingly interconnected world with significant complexity. And, you know, we all lived through COVID, the most obvious example, and some would suggest we're still living through some of the impacts of that. But the pace and the impact of the transmission of these non-financial shocks in economic terms and across the globe is as big or bigger than it's ever been. And there are an increasing number of issues that could potentially impact the financial system for Canada and the global economy, whether that's climate change, geopolitical instability, demographic shifts, decline in societal trust, and the impact of AI-based technologies. I've already talked about the regional bank crisis. Rita talked about it as well, and the impact of social media and digital technologies. And that's another potential method of transmission that's faster than it has been in the past. And these changes in the operating environment suggest deposit insurance does need to be updated to keep pace with the changes in the environment. With that, we can go to the next page. And we'll do a brief review of deposit insurance coverage, both internationally, and then we'll turn to Canada, and Rita will talk a bit about that. So Table 1 in our report shows the coverage for Canada federally, as well as national coverage across a range of countries. In Canada, most federally regulated financial institutions have a $100,000 per depositor per separately insured category per member. And as you can see in that chart, that covers a wide range of types of accounts, registered and unregistered. In the US, the limit is higher. So both banks and credit unions have insured $250,000 per depositor per firm. We also talk about the United Kingdom, where they have £85,000 per depositor per institution, but they also have something that they call allowance for temporary high balances, which I'll talk about in a second. And then Germany, as you'll see from that chart, has both statutory and voluntary coverage, which again, I'll talk in a bit more detail. So a couple of things to note about the international coverage. So, you know, one is that coverage in some countries like the US, not all countries, but some countries like our closest neighbor, is higher than in Canada on a nominal basis. A number of the countries have arrangements for temporary high balances. And this is if you happen to have a life situation where your account it has a higher balance than it normally would have. So perhaps you sell your residence, perhaps you receive an insurance payment, perhaps you receive a severance payout. And in the United Kingdom and a few other places, they've recognized that you might have a higher balance than normal. You know, there are, you know, if you do have to make a claim based on that, they do require evidence of that and confirmation. But it does allow for some people's life circumstances where they have a temporary high balance. It's not meant to provide a consistent higher level of coverage, but if you have an event in your life where your deposit is higher than usual, you can get coverage for that. And then probably and then another one is what you see in Germany, where there's both statutory and voluntary coverage. And so the statutory coverage is required. The voluntary coverage is something that can be chosen to increase. And when we get to the options that we've talked about, you'll see that's one of the things that we considered. And then there are also in Germany higher coverage levels for business. And I mentioned the reasons why that might be important. And as you can see, some countries have recognized that. Now we can turn to page 6, and Rita will talk about coverage within Canada. Over to you, Rita.
Thank you, Gerard. So in the peer countries that we reviewed, as Gerard alluded to, the coverage for banks and credit unions and building societies is uniform. In Canada, we see a large variation in deposit insurance coverage across the provinces. So we have just listed a few here. Like Quebec is similar to CDIC, as in it has 100,000 coverage per account. In Ontario, it's 250,000 for unregistered accounts, but it's unlimited coverage for registered accounts. In the Western provinces, they have unlimited coverage across all account types, as we have shown in Table 2 of our report. It gets interesting on the Atlantic side, where we see some provinces have 250,000 per account type for registered and unregistered, whereas PEI has 125,000 per account for unregistered accounts, but unlimited coverage for registered accounts. So we see a wide range of practices from coast to coast, and this is something that is somewhat unique to Canada. So this creates a bit of, this has the potential to create an uneven playing field. For example, a company that has $10 million of deposit at a BC credit union would be eligible for full coverage. But if they would hold those funds at a federally regulated institution that is covered by CDIC, they would get only $100,000 in coverage. Apart from that, we also note that there's a wide variation in the liquidity resources available to the provincial insurance funds, as well as guarantees that are available to them from their provincial governments. And we won't go into the details, but there is quite a bit of variation, not only amongst the provinces, but also the provinces compared to the federal government. So the federal insurance policy of CDIC. So with that, I'll turn it over to Gerard.
Thanks. We can go to page 7 now and talk a little bit, what are the goals of deposit insurance reform? So as GRI was thinking about what recommendations we would like to make, what were the things that we took into account? And so you can see them listed here on the page, and I'll talk about them in a bit more detail. So the first one is building greater customer confidence. And, history has shown that bank runs are triggered, generally speaking, by a lack of customer confidence. And so one of the things we want to make sure that whatever we propose, it continues to support that customer confidence. The next one is about right-sizing coverage. And so you want to make sure that a sufficient level of coverage is provided. You don't want to completely eliminate any type of risk on the part of the depositors. That's one of the recommendations of one of the international bodies. And the idea isn't to prevent all or any bank failures, but to stop the financial contagion that would require a bailout by taxpayers or widespread losses to the banking system, or to deposit insurance funds that could lead to further financial instability. We've talked a couple of times now about impact on business accounts, so there's a spoiler there when it comes to our recommendations. And they do have specialized requirements, and so many business accounts can't be accommodated with the current deposit insurance levels, and the downstream impact of the financial contagion could result in harm to the general economy, and that really should be mitigated in the interest of both general problems in the economy, but also financial stability, which is one of the core objectives of deposit insurance. There's also a desire to kind of promote greater competition among the Canadian banks. And so any changes must consider banks of all sizes, not just the large ones, but also the small and medium-sized banks as well. And then harmonization between federal and provincial deposit insurance schemes is a worthy goal, given the wide variability amongst many of the provincial frameworks, but also in comparison to the federal framework as well. So with that, I will pass it back to Rita, who will spend a bit of time talking about the different options for reform.
Thank you, Gerard.
And we go to page 8.
We'll go to the next page. Yeah. So we looked at a number of options to say, if we were to think of redesigning the deposit insurance program, what would that look like? Just as a reminder, currently the CDIC coverage offers the same level of protection across all account types. It's the same for all banks, and it's the same for all depositors. So we played around with a few different variations. So the first option that we looked at was to maintain the current structure, which is to have standardized coverage across all banks, all account types, but raise the limit from $100,000 that's currently provided. Now we, should that number be 200,000? Should it be $250 million, $500,000? I think, there are a lot of factors that we have to consider, not only the how the asset values have risen over the last couple of decades, but also, what's the right balance between providing just the right amount of coverage and not too much coverage. Regulatory reforms since the 2008 crisis have made the banking system far safer. So from a regulatory standpoint, a higher coverage may be justified on the basis that probabilities of default have reduced since the last change in 2005. Of course, we have to be mindful that this could lead to increased costs across the system. So, the first option is a higher level, but again, we're kind of maintaining it across the board. Then we looked at the second option of saying, should we have unlimited deposit insurance to for all depositors? And that's the surest way of preventing bank runs. Of course, we introduced then the issue of moral hazard, and we didn't consider this to be a viable option. This option also does not ally with the principles set out by the International Association of Deposit Insurers. Next, we looked at the option of allowing banks to voluntarily opt for higher level coverage. This is similar to the example that was previously mentioned of what's available in Germany. So in this particular option, a bank could voluntarily decide that they want to get, maybe a 200,000, a 500,000 or $1 million of limit, and they want to be able to offer that to all their depositors. Of course, there's a risk that, it could be perceived that a bank that is seeking higher coverage, it could be viewed negatively by the market. The higher coverage in itself could be viewed as a sign of weakness, and this could potentially trigger a run. Of course, there are ways that we can implement safeguards in the process. And some of the safeguards that we thought of were, making sure that there's appropriate communication to the market so that they understand that this is a proactive step taken by the bank. Comprehensive risk assessment to be carried out by the deposit insurer and giving them the stamp of approval for the higher level, as well as implementing a sufficiently long wait period prior to qualifying the bank for a higher limit. Another way to mitigate the stigma associated with individual banks would be if a group of banks voluntarily and collectively opted for higher level of coverage. So this would be similar to Germany, where all private sectors or most of the private sector banks operate for that higher level of coverage. Another option we looked at is saying, could we have different levels of coverage for different types of accounts? And in particular, we talked about business accounts. Gerard has already highlighted, some of the issues by having too low a threshold for business accounts. So, while it's easier for individuals to split their deposits held for investment purposes across multiple banks and multiple accounts, it is much harder for a business to split their operating account to stay within the bank coverage limits. So, having a higher limit for business accounts would mitigate some of these concerns and would contribute to improved financial stability in times of stress. The same. Then we thought of the concept of, how about allowing individual depositors to purchase higher coverage? Many of us have at some point, opted for CMHC coverage for our individual mortgage. Similarly, there are individual depositors who may have extremely low risk appetite. And, these could be seniors, it could be foundations, it could be not-for-profits, universities. And they may be willing to pay a small premium for the benefit of having higher protection on their deposits. This option may allow them to simplify their operations and not require them having to deal with multiple banks to be within deposit insurance. From a bank's perspective, this may be beneficial as it reduces the depositor's incentive to run. Now, these are all the different elements that we looked at, but they are not mutually exclusive. And I'll turn it over to Gerard to talk about, what is our straw man in terms of what should the future look like.
There we go. So we're on page 9. Thank you, Rita. I think it's worth emphasizing what Rita said. She talked about a number of options, and they're not mutually exclusive, and you'll see that when we come to our recommendation. There is an opportunity to add some flexibility to the system by picking elements from different parts of the options that we talked about, except option B, as Rita talked, from a moral hazard perspective, we don't think that's a great idea. And so when it comes to deposit insurance, we're operating off kind of a one size fits all structure that was set up in the 1960s and of course updated a number of times since. And so, when we thought about our recommendations for discussion, we wanted to put together a structure that's more flexible, more responsive to the needs of both the banks, individuals, and businesses, while continuing the great work that deposit insurance has done over the years in supporting financial stability. So if you look on this page, what you'll see is a couple of recommendations. So and again, it's also worth noting that these are to spur discussion. And as we note in the report, substantial quantitative analysis would be required to understand the distribution of deposits today and to predict changes based on customer behavior in response to these changes. So, this is, as I said, to kind of spur a discussion. And so what we're recommending is a basic coverage of $250,000 per account, some voluntary coverage by the banks up to $500,000 for personal accounts, $5 million per account for business accounts, so which would include foundations, not-for-profits, and corporations. Our suspicion is, and again, discussions to be had, that voluntary coverage could be offered by CDIC, and then excess coverage by customer. So this could be unlimited or determined by the insurance provider and could be offered by CDIC or by a private insurer. And what this allows is a mix of different approaches, a bit of flexibility for people and businesses in different situations, to provide greater coverage that would adjust to some of the changes, whether that's on a nominal inflation perspective or some of the changes that have occurred in the broader economy as well, as we talked about. And so a higher statutory coverage, moving from $100,000 to $250,000 per account per firm. Some voluntary coverage, again, at higher amounts, though there would be additional costs to that. And then again, excess coverage for customers up to an amount that they choose and can negotiate with either the CDIC or a private insurer. And so that takes us to the end of our review of our report. And if we can turn to page, and I would remind people, I'm starting to see questions appear in the chat. So please, if you have questions about anything that Rita and I have said or anything that's in the report, please go ahead and put them in the chat. And as I said, it's good to see that we're starting to get some of those. Now we're going to turn to some comments from Michael Mercer from CDIC. Michael is the Vice President, Depositor Solutions and Chief Data and Insurance Officer at CDIC. He joined CDIC in 2008 from the private sector after increasingly senior risk roles in banking institutions across Australia, the UK, Europe, and Canada. He's held the CDIO role since 2020, overseeing all aspects of insurance operations, including coverage, member compliance, premium administration, and fast payment capabilities in the event of a member failure. And he also oversees CDIC's digital transformation, enterprise technology, and data security initiatives. And again, you can send any questions that you want Rita, Michael, or I to address through the chat. And I will remind you again, as Vanda noted, CDIC representatives cannot comment directly on the Global Risk Institute's report or any policy implications regarding the deposit insurance framework. Any changes to the deposit insurance framework are in the purview of Parliament and the Minister of Finance. CDIC's role is to administer the framework as set out in the CDIC Act and its bylaws. And so if you have any questions directed towards Michael, we'd be grateful if you could keep that in mind during the question period. And with that, over to you, Michael. Interested in hearing your remarks.
Well, thank you very much, Gerard and Rita. I thought the report was, very timely, and I've listened intently this morning and on the dialogue. So, thank you very much for having CDIC's voice as part of the the dialogue and look forward to the discussion and questions this morning. I think you've covered off a lot of great topics, as well as the point you just mentioned there around CDIC's role in administering the framework. So that'll very much shape my lens in terms of the comments this morning. But let's first look at really what the insurance regime is. It's a limited coverage framework, and I think you certainly highlighted that. So it's really intended to cover the large majority of depositors while leaving a substantial portion of value of deposits unprotected. And so as Rita highlighted, it covers 100,000 per depositor per member institution for each of 9 separate categories. So while the limit is at 100,000 and has been at some time, we have seen expansion in those categories, and there's a lot of reach within that $100,000 limit, and I'll talk about that a little bit later on. I'd also mention that many of the banking institutions within the federally regulated regime have multiple CDIC memberships. So customers who bank with those institutions can benefit from larger coverage across the various subsidiaries or memberships that that institutional group may hold. And so that's leads to a larger protection that otherwise might be the case. So very much when you look at the inception of deposit insurance in Canada, it really speaks to covering the vast majority of small value household deposits. So really depositors who aren't in the position to judge the soundness of an institution. We very much want depositors to bank with confidence at any of the 84 member institutions that we currently have. They should be choosing banking services based on the quality of service that they get and not the safety and soundness when they're operating within those limits. So coverage is free and automatic when a depositor places their money directly or indirectly at an institution. I say indirectly, it's common obviously to work through deposit brokers. They're a key part of the financial system that we interact with. So we do review the deposit insurance framework routinely to make sure it is fit for purpose. We look at a range of external environment factors and how changes in the system is evolving, and obviously assess the adequacy of the level and scope of coverage. The last formal review, and I think Rita highlighted that, was in 2014. And so while the limit at 100,000 was maintained, there was a number of important expansions to coverage, including the inclusion of foreign currency deposits and deposits with terms greater than 5 years. There was also the introduction of separate coverage for 2 additional registered savings plans, the RESP and the RDSP, as well as a slate of robust protections for beneficiaries of trust deposits, an area that needed a lot of modernization. We've worked very closely with many industry stakeholders to make sure that process works effectively and clearly for the benefit of depositors. I'll also add in there the recent introduction of the first home savings accounts, another registered product. That brings us to 9 separate categories. And obviously, when you look back through the history of CDIC, back to 1967, the first increase in deposit insurance came from 20,000 to 60,000 in 1983, and from 60 to 100 in 2005. And it's with that lens that we very much appreciate that we're coming on close to 20 years since the change to 100,000, and obviously 10 years since that last formal review of the framework. And so we launched last year, and Gerard, I think you mentioned, in February 2023, a study of deposit insurance here at CDIC. And that, quickly followed by the events we saw in March of that year that you mentioned, the US regional banking crisis, and also mentioning the Credit Suisse situation in Europe. And that has very much shaped how we think about many factors of deposit insurance, whether it's behaviors of uninsured depositors, the regulatory response to those situations, and all the various lessons learned. Rita mentioned social media and the role that that can play. So that has certainly shaped our thinking and an evolving study that we have underway. But really, foremostly, the study is looking at how does the DI framework continue to meet its objectives to protect depositors and contribute to financial stability. And that is very much through the lens of focusing on retail and small business depositors, as I mentioned, those that we might consider more vulnerable in terms of their ability to monitor the health of the institution, but looking at both the DI limit, the framework structure, and targeted enhancements, simplification, and concepts like you've both mentioned, temporary high balances, which is a feature that we do see in other jurisdictions that could be of benefit to Canadian depositors. And our study will very much go into informing the Minister and those in the Department of Finance in their further policy evolution and discussions. So really, we see as kind of key drivers for change. It's really what's going on in the broader economic environment. Obviously, coming out of the COVID-19 period, there was elevated deposit balances that we could see across member institutions. People were saving more during that period. I'd say those balances are still elevated and somewhat now influenced by higher interest rates. And so products like GICs are much more in fashion in terms of savings vehicles and investment vehicles than they may have otherwise been in the pre-pandemic phase. There's also demographic considerations, an aging population, huge surge in immigration, and those bringing in increased sums of money with them when they're immigrating to Canada, as well as wealth transfer that we're seeing with that aging population and the need for protection around that wealth transfer as it happens going forward. Also, we have to bear in mind the increased complexity of the DI framework. We're now at 9 categories. I think key to deposit insurance is ensuring that depositors understand it and understand how it meets their needs and how they can navigate it and understand it as part of their financial security and safety. And lastly, new players and intermediaries in the marketplace. We're seeing a lot of innovative products and platforms evolving. I think Canadians are trusting a larger amount of new entrants, fintechs, and others with store of value products as part of their financial services, and understanding how that integrates with the more traditional banking system. Deposit taking and protection is key for us to understand. So just some of the key insights that we've gleaned from the study, and I would say is it's foremostly looking at data across many of our member institutions, as well as discussions we have with various stakeholders, industry groups, and as well as public discourse. We've collected around 120 million accounts at our member institutions, and looking at how deposits have evolved over time, where they sit, the types and forms of those deposits, and how they interact with the deposit insurance framework. And some of the key items that I'd note, and I really want to get back to this concept of coverage and protection. So if we think about good deposit coverage is covering the vast majority of deposits, well, today our framework covers 96% of depositors fully. So that is 96% of accounts are fully covered by the existing coverage framework. So increases to coverage would have to bear in mind the relative benefits of moving beyond 96% and the cost that would impose on the system. I think that's a key factor to consider when we think about expanded coverage. And for small business depositors, it sits at around 94% are fully protected by the current coverage framework. Now, I would say with small business depositors, and I think it was mentioned at Gerard earlier, those accounts subject to a lot of fluctuation. So taking a snapshot at any point in time, may not necessarily capture the transactional and fluctuating nature of those accounts. And I think the points raised around, and certainly what we hear from small business depositors in the surveys that we've done, is protection around transactional, payroll, and other accounts is a key consideration for them. We certainly see a large and growing role of institutional depositors, whether that's charitable and pooled trusts, the emerging role of fintechs and pooled use of funds, and how those interact with the banking system is key for us to understand, as well as the new protection measures that will be coming in the Retail Payments Activity Act with the Bank of Canada later in the year. But generally, we do see a growing level of uninsured deposits across the system. That could be for various reasons. I think those that we typically see are, we're now covering foreign currency deposits. So while foreign currency deposits are now eligible, they're very large balances in some cases for institutional depositors. So that could be a key factor in why uninsured deposits have increased. It's often good to remind depositors that our coverage framework at 100,000 covers both principal and interest. It's common for people to open up GICs at 100,000, and obviously the interest sitting above that would not be covered under the framework, and that's an important element to communicate and understand. And so with higher interest rates, we do see higher balances of uninsured. And I think just generally growth in uninsured deposits coming out of the COVID period has certainly increased deposit taking broadly in the system. So as we move forward with our study, we'll be diving deeper into some of the concepts that I've mentioned, that have been mentioned this morning, engaging a wide range of stakeholders in terms of understanding some of these concepts and how the deposit insurance framework can be further evolved and improved, and obviously providing our insights to our safety net partners and the minister for further consideration. So with that, I'll leave my comments there and welcome the discussion and questions that we have this morning.
Thank you very much, Michael. Thanks for sharing your perspective. Some very interesting thoughts there. We will now turn to the Q&A portion. Please do send your questions through to the chat, and then I will relay them back to our panelists. And so, oftentimes we open up with more of a puffball question in these types of events, or I've often seen that, not a GRI event, of course. But actually, the very first question that came up I thought was pretty interesting, potentially a little controversial, and so I'll take a cut at answering it. But then Rita and Michael, you feel free to jump in too. And so the question was that in recent years in the U.S., it's actually been rare to enforce the coverage limits. Generally, all depositors have gotten 100% coverage, even with very small banks. And so is this distorting expectations? And so we've both Rita and I talked quite a bit about SVB and Signature Bank, and in both those cases, the FDIC did come in and provide 100% coverage. They used their systemic risk exception with the idea that they were afraid it was going to cause contagion if they didn't. But I do think it's an interesting question because as part of my previous life at Bank of Montreal, I worked very closely with CDIC, Michael, and some of his colleagues on recovery and resolution planning. And in the wake of the financial crisis in 2008, there was a real desire to have banks prepare themselves for what happened if they might go under. And, in the case of the US, the question is the market discipline there if you're not going to allow banks to go under? And there is a requirement that depositors bear some of the risk, and we have a question about that as well that'll come in a second. So I do think it's an interesting question to say, what is the meaning of these limits if in the end the Deposit Insurance Corporation is just going to cover all of the amounts. And I do think it does increase some of the risk, some of the moral hazard risk. But I would also say, kind of having been in many of those discussions around recovery and resolution plans, there is a systemic stability question as well. And it is critically important that deposit insurance be seen as one part of that broader view as well. And so I don't think I've answered that question, partially because I don't think there is a good answer to that question, but it is a really good question to ask. What is the meaning of these limits in a situation where sometimes from a financial stability perspective, the better answer to come in is to guarantee all the depositors. So as I said, very interesting. I thought we'd start with something controversial, not easy to answer. Rita, did you have any thoughts?
Yes, I did want to add that. So it is a good question. And, when GRI released the report, the Globe and Mail picked it up and they wrote an article referencing the deposit insurance report that we published. And, there were a number of comments that were added to that Globe and Mail article. And it's always interesting to get a sense of what people are thinking. And I did see a number of comments that said, well, this is all theoretical. If any Canadian, well, first of all, Canadian banks are not like the American banks. And, if any of them was to go under, the regulators will make sure that Canadian depositors are made whole. So, I think that does give us that flavor of that expectation, which has set in because, Fortunately, we've not had a bank failure in a long time, and most people haven't seen one in their lifetime or not their adult lifetime. So I think that expectation is certainly building in that, you know, everyone will get bailed out, just looking at examples across the border. Michael, did you have anything to add?
Did you want to comment?
Yeah, sure. No, it's a very good question. I think, you know, really, as you said, Gerard, deposit insurance doesn't act in isolation. You know, one of the key elements of our mandated CDIC is we're the resolution authority for our member institutions, and that comes with a wide range of toolkit that we have to restructure, sell, lend, including for the largest institutions here in Canada, the bail-in framework, you know, which I think is, you know, clearly has a goal of ensuring that, you know, when there is a very rare event that may happen at one of those institutions, deposits are excluded from the bail-in framework. It's strictly towards long-term institutional debt at those institutions. So, you know, we very much practice, you know, early intervention and making sure if there is a problem in the system that it's dealt with first and foremostly at that stage. I see that happen in other jurisdictions, also the US. Obviously, the decisions that they made were based on their framework and their need to protect financial stability and depositors within their context. But I think you'll see it's increasingly common for using a wider range of tools earlier on in a crisis, because that's the lessons that have been learned through the financial crisis more than 10 years ago and crises that have developed since, is our larger toolkit used earlier can help protect both depositors and promote financial stability without relying purely on an insurance limit at the end of the day. These two elements, an insurance limit and a good functioning resolution regime, act as complements to make sure that mandate of protection and stability work well together.
A related question that came up was, and Rita, maybe I'll direct this at you, is how much risk should the depositor assume when it comes to deposit insurance?
Well, I mean, I think to prevent moral hazard, depositors should make a judicious decision around where they're going to be placing their deposits. I know that, you know, many depositors will look at the size of the bank as a proxy for safety stability. A lot of people try to stack their deposits at the larger institutions. That enables them to provide higher level of coverage than they would have otherwise received. I think it's been pointed out that some of the larger banks have 2 or 3 insured entities, so you can double or triple that insurance availability for an individual. That's not available for funds at a small and medium-sized organization, or it would be too expensive for a smaller, medium-sized bank to be able to have multiple entities within the same group. So I think, you know, it's not just how much risk individuals should take, but also, you know, how do we foster a more competitive marketplace for deposits? I think both those things are important, and I feel that some consideration as we are reforming the system to be given to having a more competitive situation such that depositors have more choices. Michael, anything you'd like to add?
No, I'll just point out, Rita, that like we don't have competition as an explicit part of CDIC's mandate, but in terms of the risk-taking of individual depositors, I think you're right. You know, it's up to them to make the best choices for their financial needs, and we want to ensure that there's broad awareness of deposit insurance. It functions, you know, effectively, and Canadians can have confidence in how it works and functions, so that armed with that information, individuals can make the best decisions that are out of their circumstances.
I'm going to try and combine a couple of different questions here because we are getting a good number of questions, and it's about the difference in the quantum of limit of coverage versus complexity. And so it's this idea that has kind of been implied a little bit that, we may have a $100,000 limit, but we cover a large number of accounts, different types of accounts. I'm going to combine that with a question that's come up a couple of times and that Rita just mentioned around, some of the larger banks in Canada do have multiple legal entities and so can spread coverage across different entities. And then the third one is someone in the question made the point that depositor awareness is an important part of everything that, is an important part of the success of deposit insurance. People have to be aware that the coverage exists and what it means. And so, maybe, and Rita, maybe I'll start with you, and then Michael, you can jump in, and I have some thoughts too, about this debate between, a simple coverage limit per depositor versus, potentially covering multiple accounts, potentially with multiple legal entities. And now we're adding on top of that, when you think of our recommendations, even more complexity between statutory versus voluntary, personal versus business. And how do you think about all of that complexity in terms of how that gets communicated to the general public? So maybe Rita, I'll jump to you first, and Michael, if you want to jump in too.
Yeah. Very good question for sure. I mean, how much complexity versus, trying to keep things uniform, and there's certainly trade-offs, and there is no one easy answer. But, as we were writing day-to-day decisions, simple decisions like buying an airline ticket or even booking a hotel, we have so many choices that we have to make today. It's not as simple as it used to be many years ago. There are like 5 types of fares that you can choose, and they have all different levels of flexibility in terms of being able to make choices or to get refund. You pay extra for meals, you pay extra for a window, you pay extra for bags, etc. So a simple transaction flying from point A to point B involves a lot of choices. Compare that to, and I will say that this is sort of more a product that we've seen in the last few years. Compared that to a bank, where we actually don't have to think too hard. And, we kind of have to think of that 100,000 limit, but beyond that, not too much. And I would argue that perhaps, getting people to think a little bit more and introducing a little bit of friction in the process is actually good for customer awareness and engagement. And, a little bit of complexity may actually force people to think a little bit harder about some of these decisions and, prevent that moral hazard saying, I don't have to worry, the government's taking care of me. I know it's a little bit controversial what I'm saying, but I do feel that, greater awareness and engagement will make consumers more aware of the risks they are taking. And yeah, definitely, I think all of us have a role to play in enhancing education and increasing consumer awareness.
Michael, did you want to jump in?
No, I think public awareness is key. And it's a big pillar and platform for CDIC. We're very active in terms of our public awareness activities and working very closely with stakeholders, including the Financial Consumer Agency of Canada in their work on financial literacy and broader education. And so what we do see is deposit insurance has very broad understanding across Canada. It sits well above 60% in terms of public awareness. As a brand, that's very enviable for brand awareness and for an organization like CDIC. It's good to see that message resonates for Canadians and depositors. I think I would certainly caution the idea of making the regime so complex that it becomes very difficult for people to navigate and understand, particularly at periods where we would expect individuals to care most about this when they are sensing concern or issues in the financial environment. And so we want to make sure that when individuals and depositors have those concerns, the information is simple to understand, meets their needs, simple to access, and conveys the protection and stability that really the framework is all about. So I think there's a balance between simplicity and making sure that the awareness very much resonates when individuals are making these decisions.
Thank you, Michael. And I will utilize my position as moderator to steal the last word in the Q&A session. And really, in a sense, just to reiterate what Michael and Rita were saying was that, if you are going to increase complexity, I think the test would be, there has to be real value to that, because, we do want depositors to understand it and to be able to communicate it. And so if you are going to introduce complexity, I think you have to have a really good reason and a really good rationale for that. And I think you even if you do, in some cases, you might want to stop before you make it too complex. But thank you to our panelists, and thank you to our participants for what was a very interesting session. Lots of great questions. Unfortunately, we couldn't get to all of them. And with that, I will hand it over to my colleague Vanda to wrap us up.
Thanks very much, Gerard. And thank you to you, Michael, Rita, and Gerard, for sharing your insights with us. This is a topic that affects us all, and I hope today's event serves as a jumping off point for continued discussions about the future of the deposit insurance system in Canada.